While competitive pressures and high input costs hurt drug makers by and large, companies that supply active pharmaceutical ingredients or APIs in them are in reasonably good health. Regulatory crackdown in China and higher scrutiny by the US FDA are in fact proving beneficial for the API manufacturers. Darshan Mehta is standing by with a closer look at their financials to tell us what's working for them. Darshan, good morning. Why have you chosen this pack?
Yeah, so basically, if you take a look at the earnings season has ended and pharma as a space didn't do that well, at least on the formulation side. But over the past 2 quarters, what we've seen is as a theme, the API companies have started to do well, and there are a couple of reasons why they've started to do well. So firstly, we'll take a look at what has happened. So we've considered companies like Divi's, Laurus, Solara, Hykel, IOL, Newland and Granules. Most of them are API except for Granule, which has a substantial part of their revenues coming in from API. But companies like Divi's, Laurus, Solara, Hykel, IOL, all of them are pure play API players and API suppliers. So if you're looking at the revenue growth, obviously all of them have seen a traction that's happened from levels of 1,000 crores over the past last year. Divi's has moved to almost 1,300 crores. So there is positive traction that's happening. Similar is the case as far as the bottom line is concerned. The EPS growth has been very strong. Now the margins over the past 2 quarters, you can see that have started to move up significantly. Solara, we just have 2 or 3 quarters of earnings that have come out, given the fact that it was recently listed and hived off. But the margin trend is gradual, given the fact that their input costs have also gone up. The EPS numbers, actually look at the EPS numbers that have come out, and all of them have actually shown a big spike as far as the EPS is concerned, at least over the past 2 quarters. So these are the pure financials of the company. Let's take a look at what are the important factors why API companies have moved up. First of all, the most important factor is the China factors. There was a big crackdown as far as polluting industries is concerned. That actually impacted a lot of oversupply and overcapacity was concerned. So China is the largest API supplier to the world, and because of companies there facing shutdown, the oversupply demand actually changed there. Apart from it, higher operating costs post the new EHS, environmental health and safety norms. So what happened was, because of the China curbing down this, the EHS put out new norms, and to comply with that, the cost advantage or the arbitrage that the Chinese companies had over the other peers actually came down. To set up the new plants, the cost actually incurred was much higher. And secondly, because of the arbitrage, a lot of companies, Indian companies which were outsourcing their deals from China, and because of price going out, they are now taking supply straight from the Indian companies. So the China factor was a big factor in which why Indian API companies did well in trade. The second factor was basically the scrutiny that happened. Scrutiny globally now, initially scrutiny was happening at the formulation plant, and now ahead of the API plant there is scrutiny that is happening at the intermediate plant, which means that there also the FDA is getting stringent. That's why API plants will actually need significantly to boost up their sales and diversify. Impurity threshold was cut post the Valsartan issues that happened. A lot of Indian formulation companies was also affected. Companies like Aurobindo, Torrent had to recall a lot of drugs. So because of that, the formulation company have started to diversify sources of API. So initially, when they were sourcing 100% of their drugs from one company, now they are diversifying and sourcing it from multiple agencies so that the drug problems or these formulation or recall problems don't happen. Because if they do a recall, that's a big cost for them and a big issue as far as FDA is concerned. So that's one of the second reason. And finally, if you're looking at it, the investments are now paying off. The asset turn is now turning favorable as competition is dropping significantly. Initially, if you saw that margins of the API companies needed a certain threshold of margins to come in, but because of the China factor and competition, their margins were subdued. Now the asset turnover is going much higher, and that is why the Indian firms have actually hiked their capex spend aggressively to take benefit of that. So 3 main reasons: China, the asset turn and competition dropping down, and the regulatory issues coming out, which makes it tougher for the arbitrage going out, aided a lot of API firms this time.
I just had one small question, Darshan. I looked at the margin chart that you put out. the margin uptick over 5 quarters for a company like IOL, for example, the red one, has been quite spectacular. Have they done something really special?
Yeah, so basically, certain companies are 100% API, 100%, some like a granules are partially API, so they supply. So IOL benefited significantly because they got their, over the past 2 quarters, I think the red one is the IOL, from 12% to 23%. And if you see, it's been over the last 2 quarters. So from the first quarter of last year, the China issue supply started, and that is why they started seeing a lot of margin uptick that came in. So that benefited them significantly.
Actually, even Divi's from 31 to 39 at that size.
So Divi's was always, levels of 30 to 35. They dropped because of the US FDA import alert that came out.
And now
they've started coming back. They have started getting a new products, and their new capacity also starts kicking in. So the utilization rate, once it goes up now, that's why they benefited. But Divi's historically was always one of the best, EBITDA operationally in terms of performance, operationally one of the best run companies.